Okay, so I'll get us started here. Like I said, thanks for joining us on a Saturday morning here to talk about Trustee School, with the emphasis on our special needs trusts. As we all know, special needs trusts, it's a strange animal. Being a trustee of a special needs trust is not the same as being trustee of just a typical trust. You have all these nuances that you have to worry about. And when you're the trustee of a special needs trust, you also are probably wearing many more hats than just trustee. You might be the representative payee for Social Security. You might be guardian of person and estate of the beneficiary. You might be handling the Medicaid application. You might be handling the Social Security application. Many hats. So our goal here is to try to make this as less complicated as it can, but knowing that this is a very complicated process and an understanding of what we need to do. So our goal here today is we're going to review the basics of the governmental benefits that are out there first, because that's the whole reason why we have special needs trusts, is to protect those benefits. Then we're going to explore the relationship between these benefits and the trust administration. So what can you guys do to make the benefits as high as possible, but also the benefits of the trust as high as possible? In order to do trust administration, we have to understand what the trustee responsibilities and obligations are. And then, so we're going to talk about this trust administration and making sure that we have the proper parties in place, including care managers and case managers from all governmental agencies, including maybe even some social workers that could get involved. All right, so trustee responsibilities. So, the typical case is, a parent has passed away and now I'm the successor trustee, and now I'm taking over management of the trust. And it can be overwhelming, especially if they know some things about the trust. Mom told me, yeah, I'm the successor trustee of this trust, but that's all I know. That could be daunting, and what we always recommend is, getting the family members involved from the get-go, making sure that, the successor trustees do understand what this is. And that way they're not kind of blindsided when, the trustee does pass, the original trustee does pass away. But where do you start? You just became a successor trustee. Well, it sounds pretty basic, but you need to read the trust document and getting a handle of, okay, who are the parties here? What does the trust really say? You might not understand it all. There's a lot of legalese in there. There's a lot of provisions that probably won't apply. But that's your first step. Let's look at the document. Let's get a handle on what's going on. And then you might want to meet with your attorney. And it doesn't have to be, Hickman Lowder. It could be, any attorney that has, special needs experience. Meet with that attorney in order to get the groundwork of the lay of the land. Fiduciary obligations in a special needs trust, typically you should have only one beneficiary, and that's the disabled beneficiary. And your obligation is to that beneficiary. You are supposed to be using this money, managing this money, investing this money for the benefit of this beneficiary. The responsibilities of those obligations are investing it. It's making disbursements for the benefit of the beneficiary, keeping good records. That's incredibly important with special needs trusts, because many government agencies Job and Family Services, Department of Medicaid, Social Security, they're going to want receipts, statements, canceled checks. Good record keeping is key for a trustee of a special needs trust. Because these are special needs trusts, you have reporting requirements to these governmental agencies. Typically, that's on an annual basis, but if someone's on SSI, that could be a monthly obligation of providing statements, documents, and receipts. And then, of course, there's taxes on an annual basis that, just as you as an individual would file a 1040, the trust might have to file a 1041. Because we're dealing with disabled beneficiaries, you have an advocacy component that we put in most of our trusts, that the trustee is an advocate for the beneficiary. So the trustee can either hire an advocate or be that advocate to ensure that their quality of life is being the best that it can be. You know, getting in front of those IEP meetings at school, getting in front of those ISP meetings at the DD board, being that advocate in front of the medical providers. So, you know, a trustee that has legal expertise or financial expertise or representing that they do, their level of care as a trustee, it becomes even greater. If they hold themselves out to being an expert, then their responsibilities are heightened. So that's something to keep in mind. As a trustee, you are a fiduciary. So you have a fiduciary duty to manage this money, and you have a fiduciary duty to not self-deal. The default rule is, you know, there's no self-dealing between trustee or between trustee and the trust, or trustee and immediate family members. So what does that mean? Well, what is self-dealing? Well, you shouldn't be borrowing from the trust in order to pay the trustee's individual responsibilities. The trustees shouldn't be taking money out and investing it in their business. There shouldn't be any sales or purchases from the trust that benefit the trustee individually or their immediate family members. And there should be no commingling of assets. The trustee shouldn't have, you know, $25,000 of their own money mixed in with an account under the trust name. It should all be separate. The trust is its own entity, so all accounts should be titled under the trust name. And then we also wanted to point out, you know, there should be no commingling of the beneficiary's individual assets and income with the trust income and assets. It should all be separate. The trust should be its own individual entity. So you have these fiduciary responsibilities to invest, to report, to do taxes, but that doesn't mean that you individually, the trustee, individually has to do these duties on their own. The trustee can delegate these duties, and that means they can hire professionals in order to, you know, help them file for taxes, help them invest. I'm not an expert in the stock market, you know, but I rely on my financial advisor to help me with that. And same with taxes. I rely on my tax preparer to help me with that. The same should be true for the trustee of the special needs trust. So, you know, especially with the care manager component of it, if they are an advocate and the trust wants them to be an advocate, that doesn't mean that they have to be the advocate. They can hire the advocate in order to get a care plan together. So the investment side, most people aren't financial advisors, but they should know the basics of, their fiduciary duty to invest. And it doesn't mean that you invest everything in the stock market with a risky investment, or in one stock or one portfolio. The Ohio Prudent Investor Rule says, okay, you have to be reasonable. You should diversify. You should use the modern portfolio theory. And what that says is, put some in the checking account, put some in the stock market, put some in bonds, diversify. It's what this slide wants to tell everyone is, what I'm trying to get across is, we should properly invest trust assets, but that doesn't mean that you are an expert. And that's why hiring someone or getting someone involved to delegate this duty should be a priority, because this money, although this money is set aside for this special needs beneficiary, we want this money to grow. We want it to be extended beyond its years. So investing it is, a useful tool. Reporting requirements. Like I said, we have many governmental agencies that will want documents in order to retain benefits. And this is what really sets a trustee of a special needs trust apart from a typical trustee of a trust. If this is a court administered trust, you have annual reportings to the court with accountings. You have annual redeterminations to Job and Family Services if this person's on Medicaid. If this person's on SSI, you also have annual redeterminations. And as I said before, with SSI, you might have to provide monthly statements and monthly distribution requests of what's happened in the trust to Social Security. Typically, what we advise clients is, save the bank statements and pay a little bit extra to get canceled checks on those bank statements. So that way, if they ask, if the governmental agency asks, what's this $555 check that you wrote in December of 2023? Oh, it's right off that bank statement. It's made to this medical provider. You've got the documentation right there. Just makes it a lot easier than having to go back to the bank, asking for these canceled checks, which would be much more costly in the long run anyways. So what we advise is, get the bank statements, get the canceled checks, put it in a folder. Get as many receipts as you can, put it in a folder. That way, when that annual redetermination comes, you have everything in a folder. You've got it, 75% organized. And it just makes it that much easier to present to those agencies when they ask for it. When I say it's an annual reporting requirement, I mean, they can ask for statements and documentation at any time. So that's another reason why, just be ready when they do ask for it. And that's why it's just easy, just throwing it, setting it aside, keeping track of it, putting it in a folder, you're good to go. We wanted to provide this as well. This is a version of trustee compensation. In our trusts, we have a reasonableness standard. Reasonableness standard is typically what your local probate court would determine as in a fee computation schedule. And it can look something like this. It can be a little bit more complicated by taking the principal of the trust, taking the income of the trust, and taking distributions that you've made over the past year and going through this formula, and it spits out your fee compensation. Many courts have a minimum fee that's allowed. You know, if the trust isn't really making that much income, well, they have a minimum of $500 or $1,000 in a fee that a trustee is allowed. Just because the fee is there and you're able to take it doesn't mean that you have to take it. And many family members say, well, no, I'm going to waive that fee. I don't need to take it. And that's perfectly okay. You don't need to take a fee. But if I always tell clients, listen, if you are, you know, taking a lot of time, and if this is like a second job, then you should be compensated. If it's taking away from your primary job, then absolutely, you should take some compensation for this, because, you know, you're managing it. But that's all up to the trustee, you know, what the trustee wants to do. And it's all based off of a reasonableness standard. So trust administration, as we go on here, there's other special challenges other than the reporting requirement for a trustee of a special needs trust. And, you know, that's we're helping our disabled family members and friends, and there likely will be diminished capacity as we go on. So how are we going to manage that? How are we going to make sure that the needs of the beneficiary are being taken care of? Maybe that means that we have to be more in touch with the local developmental disabilities board, with their case manager. Maybe that does mean I have to hire an advocate, a case manager, to go out and meet with him or her and determine what are the needs, what are they having trouble with. Another thing that a special needs trust has to deal with is the status of the state as the beneficiary. The whole reason why a special needs trust is an exempt asset for a disabled beneficiary is this Medicaid payback provision at this beneficiary's death. The state of Ohio is a super creditor. So that means that they get the first bite of the apple at the beneficiary's death to the benefits that they've given them throughout their life. The primary beneficiary may have outlying income needs, meaning the beneficiary might be receiving SSI or SSDI, and it might be enough, it might not be enough. And how does the trustee give this person money that they need and not jeopardize their benefits? And we'll get into that a little bit later when we're talking about Social Security and how we manage that. And of course, if this is a trust administered or a court administered trust, you have the court to deal with. And that just complicates things entirely. It makes, you know, sometimes you can't avoid that, but we try to avoid the court as much as possible. If we can create a trust outside the court, there's just less, you know, red tape that you have to go through, because you guys deal with enough red tape. Other special challenges that we have to take care of with these special needs trusts. Are there benefits out there that the beneficiary could be on or should be on? What if they are denied benefits? These are kinds of things that, you know, a typical trustee doesn't have to deal with. And if the trustee does, you know, make a mistake and the benefits are jeopardized, then the trustee has to act to reverse that. The trustee has to make sure that caretakers and caregivers are the appropriate people taking care of this beneficiary. We also want to make sure that the equipment and services for the beneficiary are the appropriate, are being appropriately used. And then on top of that, you have family members of the beneficiary that might want to be involved or that shouldn't be involved, that are involved. And finally, what I always advise my clients when they are drafting a special needs estate plan is, get a good letter of intent drafted. That way your trustee and your family members do have this guiding post of how you want this money managed for the trustee, how you want or for the beneficiary, and how you want your beneficiary's life to go on without you, where they want to live, who should be taking care of them. The letter of intent is not a legally binding document, but it is extremely useful, and most trustees are extremely grateful having that letter of intent in place to have that guiding post. All right. I'm just looking at my slides. I think this is my last slide. So the basic disbursement rules of these trusts, the trustee has the sole discretion to use or not use this money. And they have the discretion to use this money for basically anything for that beneficiary's needs, except for a few exceptions that we have listed here. We want to make sure that payments are made directly to the provider and to the creditor. So if it's made to the, to Best Buy for that TV, it's made directly to Best Buy. If the beneficiary needs a new medical equipment, well, it's made to that provider. We don't want payments given directly to the beneficiary because that might jeopardize Medicaid and SSI benefits. And we really don't want, if the beneficiary is on SSI especially, we don't want payments made to food and shelter expenses, because that might jeopardize SSI benefits. These are obviously presumptive rules. There's exceptions to this. If an SSI beneficiary uses all of their money on their rent and food, there are exceptions that you can use money from third parties, including a trust, to pay for these services. And you can utilize a stable account, which we'll get into, where the beneficiary has a stable account and money is distributed to the stable account, and that can be used for food and shelter expenses. So there's ways of getting around that, of these, food and shelter rules and cash to the beneficiary, but these are, the default.
Okay, I'm going to talk about the next couple of slides. Now that Ethan has gone over the basics of what the responsibilities are for the trustee and trust administration, we want to talk a little bit about trust assets or trust property. And those actually are used interchangeably and they mean the same thing. Sometimes people are confused about that, but trust assets and trust property are the same thing. So trust property is anything that has been titled to or otherwise assigned to the trust for the benefit of the beneficiary. And, these trust assets can be almost anything. They can be bank accounts, stocks, bonds, investment accounts, real estate, automobiles, tangible personal property. But the important thing to remember, once you've executed your trust, you've signed it in the presence of a notary, your trust exists, it's in effect, but it doesn't have any assets until you assign them to the trust. So nothing is automatic, and that's something that especially a new trustee might need to really understand. You just because you executed a trust doesn't mean you have any trust assets. You have to take an action to fund it. So when we're talking about special needs trusts for the benefit of a disabled loved one, oftentimes the intent is, hey, we want to provide for them financially, especially after, maybe their parents are gone or other family members are gone. But one thing that kind of bubbles up as a frequent concern at the top of the list, parents want to make sure that their disabled child has a home to live in. Oftentimes parents would like, for as long as possible, to have that disabled person remain in the family home. And so, it might be appropriate to have the house titled to the trust. And that's something that frequently people will do. They will, execute a new deed that assigns the house to the trust. Or instead of that, they could do what's called a transfer on death designation affidavit, which means, maybe after the parents die, the house will automatically move into the trust for the benefit of the beneficiary. And so that's a good thing, and that's frequently done. We just want to, point out a couple of things about that. A little bit later, George is going to go over the different types of trusts, first party versus third party. You certainly wouldn't want to assign title a house to a first party trust that's subject to Medicaid payback, because you don't want the state getting the house. So the trustee has to be mindful when making decisions about, whether the house belongs in the trust or not. Another thing, if the intent is to keep a disabled person in the home as long as possible, it's not just enough that the trust, the house is in the trust. You have to have enough money in the trust to keep the house up, maintain it. And so that could be something that trust assets are used for. But you have to also be mindful there, because if the trust assets are used to pay the mortgage or to pay the taxes or to pay the utility bills, that could be considered income to the beneficiary, and that could result in a reduction if they're getting SSI or those benefits. So we'll talk a little bit later about how these things can affect SSI, but kind of the takeaway here is that the trustee just needs to be mindful and make decisions that are appropriate for that beneficiary to make sure that, as much as possible, you're not dinging their benefits, but that you're also providing for them wisely. So that's what we have on the residents. Next slide. So another thing that's frequently of concern to parents would be vehicles. And, can the trust buy a vehicle for the beneficiary? Yeah, it absolutely can. The trust can also pay for maintaining the vehicle and putting gas in the vehicle. And then the question comes up, well, should the vehicle be titled to the trust? Should the vehicle be in the trust? And there again, there's not one right or wrong answer. You have to think about that one carefully, because there are pros and cons. It's certainly logical that if the beneficiary is a minor disabled child, or maybe an adult who's never going to be able to drive, you might think, okay, the trust should have title, which it can, but then there could be some potential liability issues if the trust holds title. Could also make it difficult for the person who's driving the car to get insurance if they're not the trustee. So these are the types of things that the trustee needs to consider with respect to a vehicle. Other things that trust assets could be used for that you might not think are obvious. Let's say a family member is the caregiver. Well, the trust could, maybe buy a life insurance policy for that family member caregiver, so that when that person dies, at least financially, there's a way to replace the care that is being received. Another thing that you can do, and this is in particular, this is a good idea if it is a first party trust, and if it's a trust that has a Medicaid payback component, you might want to use some of the trust funds to prepay funeral arrangements for the beneficiary. You do that from the trust before they die. And then, that's less money that goes back to the state, less money that the family has to come up with. So anyway, there are many considerations that the trustee will have to think about with respect to what should the assets be, how should the assets be, used. So that's all we want to say about that for now.
All right, thanks, Helen. And I just wanted to piggyback on the vehicle. Typically what we advise, in every case is different, but if a vehicle needs to be purchased, especially maybe a handicap accessible vehicle, that we have the title of the car in that parent's name or in the trustee's individual name, but the trust then holds a lien on that vehicle. So right on the title, it will say so-and-so special needs trust as a lien holder. And we might even do a promissory note in addition to that, to make sure that the trust asset is protected. Putting it in the name of the trustee, that way it's protected from liability reasons. The insurance may be a lot less and more accessible if it's in an individual's name than a trustee's name. But as Helen said, it really depends on the circumstances. I had a couple questions that were directed to me I just wanted to touch on before I moved on to taxation. There was a question about, elaborate on the term fiduciary. So a fiduciary is just a blanket term of, someone that has a legal obligation to someone else. So common fiduciaries that we see in our line of work is the trustee. They have a legal obligation to the beneficiary. An executor of an estate, they have the legal obligation under the will, the last will and testament, to the beneficiaries under the will. Then you have an agent under a power of attorney. They have a fiduciary obligation to the principal of the power of attorney. A guardian under probate court, they have a fiduciary responsibility. Some financial advisors, they have fiduciary responsibilities to their client to, invest in appropriate stocks that don't necessarily benefit the financial advisor. So a fiduciary is just a blanket term used as the person that has a legal obligation to someone else. Another question, which we'll get into this a little later, about SSI. Yes, also security, SSI, SSDI, they require you to deposit those funds in a representative payee account that's under the disabled individual's name, and the representative payee is also attached to that. It should not be on the it should not be directed to the special needs trust. Another question just popped up was, if a vehicle is titled to the trust and there's an accident, can the trust be sued? Yes, I mean that's why we don't want the vehicle, necessarily titled in the trust, because if there is an accident, then they can they can sue the trust and the driver, and the assets of the trust could be, jeopardized. So and then another question that popped up was, do we have any templates for letters of intent? We do have templates, but really it's tailored to the individuals, and the individual families. And what we talk about is what are the financials? What are the habits of the beneficiary? Where do you see this person going to school? Where do you see this person living? So it's really tailored to the families, but I mean, we do have templates and so forth. Venmo, someone asked a question, can Venmo be documented instead of a check? Sure. I mean, you can, any debit from a bank account to, directly purchase to that creditor, as long as you have a receipt or the invoice showing, yeah, I paid $500 for this, and here's the invoice, you connect the dots. The more documentation, the better. All right, so let's move on to everyone's favorite topics about taxation. Obviously, we're not, tax attorneys, we're not CPAs, but we know enough about special needs trusts and taxes to be dangerous. Essentially, the taxation of special needs trusts, the goal here is to carry out all income that a trust generates to the beneficiary. And the reason why we want to do that is the trust tax brackets are so much worse than an individual's tax brackets. If the trust makes more than $10,000, they're in the upper echelon of tax brackets, being taxed at 39%, where an individual, they have to make more than $550,000 to be receiving that 39%. So we want to try to push as much tax liability to the beneficiary individual as possible. And the way that we do that is any net taxes that the trust generates, and I say net taxes because there's expenses that you get to write off with attorney fees, accountant fees, anything else that would be tax as a tax write-off as an expense. The net income that the trust generates is then pushed out to the beneficiary through a K-1. And then with that K-1, then that can be taxed on that beneficiary's tax return. With a self-settled first-party trust, self-settled meaning that either that beneficiary created the trust or the parent created the trust, the money is there because that is the beneficiary's money. They're the ones that put it into this trust. You can use the beneficiary's social security number to do the 1041, but typically the best practice is just generate a new EIN, an employer identification number, a tax ID number, to connect the dots with the IRS. So that way the trust has their own social security number and there's no confusion over where this money is and where it's going. So this might, worry people that, hey, I don't want my disabled child or family member filing a tax return because that's going to jeopardize their benefits. Well, that's not the case. There's a difference between taxable income and benefits income. Benefits income is very broad. If there is $100 being deposited in a beneficiary's bank account, their representative payee account, for instance, yeah, Social Security's, if that person's on SSI, they're going to say, hey, they received $100 in unearned income, and we're going to dock their Social Security for next month. That is a broad definition of what taxable income is. Taxable income is what's on their individual 1040 and what is then distributed or sent to the IRS to determine what taxes need to be owed. So as we mentioned before, the trustee needs to present and keep all evidence of distributions in that folder so that they can prove that this taxable income is not reported as income under Social Security or Medicaid's definition of what income is. Because there's caseworkers, as everyone probably knows, caseworkers, sometimes they have their own rules. So we're going to get into the difference of a first-party trust and a third-party trust, but for tax reasons, we wanted to mention what there are a little bit of differences with a third-party trust taxation compared to a first-party trust, because they're a third-party trust. It has a little more tax advantages with being classified as a qualified disability trust. So typically a trust will only receive $100 or $300 exemption. With a qualified disability trust, that is actually up to $4,500. So it's, you know, it's a huge difference with a tax exemption being classified as a qualified disability trust, and only a third-party trust would be able to get that tax break compared to a first-party trust. The undistributed income is taxed to the trust. So if the trust distributes $25,000 to the beneficiary over the last tax year in payments for expenses and, you know, in debts, but the trust has $30,000 in income that it generates, you know, on its face, on paper, there's $5,000 of taxable income that would be taxed by the trust. So with all that being said, you know, make sure that you are using a tax preparer that has filed 1041s and knows how to reduce the tax liability on these special needs trusts. Most likely a CPA would be able to help this. I've got some questions here. The question was, what separates taxable and non-taxable deposits into the trust? Well, you would get that from a 1099 of what is taxable and what's non-taxable. At the end of every year, the 1099 will show what income the trust has made from a certain account and what and a non-taxable deposit would be everything else that's not included in that 1099. If a parent, another question is, if a parent is paying a substantial part of an individual's housing, is that considered income? Yes, that is considered income. That's for SSI purposes, and we'll get into that. It's called free food and shelter expenses, which we want to try to avoid. So we'll get into that as we move on here. All right, George, you're up.
So we're a little under a third of the way through our presentation, and it's almost 11. So I'm gonna go through the care management portion here kind of quickly. As Ethan touched on earlier, you know, the trustee wears all of these various hats, and some of them are more financially oriented, you know, talking about taxes, talking about investments, talking about property management, and some of them are more care oriented. So being an advocate, dealing with the needs of the beneficiary. And you know, people all have their strengths and weaknesses. And so, you know, somebody who is good with the nuts and bolts and the books and the finances may not be comfortable with sort of the more, to say, touchy-feely aspects of the role. Or perhaps they live, in a different state or a different part of the state, and so they're not physically present as often. So in this case, you can hire someone to act as a care manager for the beneficiary. So, and there are professional care managers. Our firm offers that service. There's any number of other providers out there. And typically, especially if this is a trust that was set up by parents for their beneficiary, and now someone else is stepping into those shoes, the parents were the ones who managed the care for their child, during their life. And now they've either passed or they're stepping back from that role. And there may not be somebody else, close and present who can do that. And that's where a care manager can come in. So if you can hit the next slide, Ethan. So, professional care managers, these are people that do this for a living. So they're typically social workers or health and human service specialists. They help care for help families access the care. They're not caregivers themselves. They are facilitators. So they give guidance, they advocate, they problem solve. A good professional care manager is going to know the systems and know what's available, what's out there, know who to call, what strings to pull, what sort of ways that you can, get the beneficiary, get the family, the trust connected with the services that the beneficiary needs. Go ahead and hit the next slide, Ethan. And they can do a lot more than that. So a good professional care manager is going to have a knowledge about government benefits, what those rules are. They're not an attorney. They're not going to know, chapter and verse, but they're going to have enough experience to know, what in general, what to look out for. They're going to be keeping on top of the beneficiary situation, particularly for beneficiaries who have some level of their own independence, but they perhaps need some checking up on, some guidance, some periodic and from time to time just checking up on. The care advocate can serve in that role. They can help the beneficiary communicate to the trust or the trustee for what's appropriate to ask for and what ought not to be distributed. Again, finding placement, providers, facilities, hooking the beneficiary up with services that are a good fit. Or coming in and reviewing what's in place now. Is it working? Is it not working? How could it be changed? All that. And then presenting this to the trustee in a form that is concise and a plan, an annual care plan. So that's really what that professional care manager can do. I'll stop here for a second. I've got some questions. Can you hire a family member to provide care? So the short answer there is yes. What we would recommend doing for a number of reasons is have formalize that relationship. So one, if the care that's going to be provided is some form of skilled care, if the family member has the appropriate credentials to provide that care, that's fine. But bear in mind, the trustee again has that fiduciary responsibility, and that extends to hiring qualified caregivers. So if there's going to be some amount of care that requires a particular skill, you're going to want to make sure that family member has that skill. If you're hiring instead more for just sort of hands-on home health aid type of services, again, we want to have that relationship formalized in a written agreement, with the amount of payment commensurate with what the going rate is for that kind of care in the area. Making sure that the care provider does in fact then report that income as appropriate, so that it is completely above board. This particularly comes into the context with Medicaid and SSI benefits, which have detailed transfer rules, where if a payment from a beneficiary or for a beneficiary doesn't receive fair market value, it can be considered a gift. So having that formal relationship in place provides the evidence that this was a bona fide transaction for value. But that's a good question. Yes, if family members are going to step up and help provide care, they can receive some compensation, but it's got to be structured and formalized. So then, next question here: if the trust is, so I would, so as far as the tax questions, again, I always say I'm not a tax professional. I don't play one on TV. I think that the tax issues are become more clear as the trust receives tax documents from its annual activities. And then you can,
if the trust only has checking account and a savings account, they're not going to be generating that much income. You have to generate more than $600 in income to actually file a tax return. And even if you have to file a tax return, it doesn't mean that you have to pay any taxes, any tax liability. So the threshold is for a trust, it's very low. For an individual, you have to make more than $14,000 to file a tax return. For a trust, you have to make more than $600 in order to file a tax return.
Typically, the situations where we see that trusts even run into tax issues is if the trust holds property that generates income. So, for example, if there's a rental property that's held by the trust and it receives income, or if the trust holds securities, stocks, bonds, things like that either realize a capital gain or dividends or things like that. Those are the situations where tax issues come into play. Having money just sitting in a checking account, by and large, doesn't generate enough what would be considered income by the IRS to touch on a tax liability. And then let's see. So the question is, trustee for someone who lives, the trustee lives out of state. What can they reimburse themselves for? I mean, in particular situations, every situation is different. So, we would encourage you to check with somebody like us about your particular details. In general, the question is it reasonable? Was it reasonable and necessary as part of the duties of the trustee? And I think that's really it's a highly factually dependent question. So, there's no simple direct answer to that. So, just to really briefly mention, we do have a professional care manager on our staff, Janelle Leonard, a licensed social worker. She is incredible at her job. She does fantastic work. I would highly encourage anybody who's looking for a professional care manager to check us out. But again, you can use the trust resources to pay for the care manager, so the trustee doesn't have to go out of pocket on their own. And just finding a good professional care manager that has experience with people who are beneficiaries of trusts is essential. So, all right, go ahead. So switching gears then, now back to more of this sort of hard-nosed aspect of being a trustee. What are your reporting requirements to the benefit agencies? So we'll get into this in more detail here later on, but typically a disabled individual can either receive benefits that are means tested or not means tested. So the means tested benefits are SSI and Medicaid. SSI providing income providing money for the individual, Medicaid providing primarily health coverage for their health care, and then also we'll get into these Medicaid waivers as well that provide for other services as well. So you need to report to the agencies that are means tested, because they need to evaluate the trust itself and then how the trust is operating to determine whether any of that trust assets or its activity have an impact on the individual beneficiary's eligibility. So the typical points where you have to check in: when the trust is created, it's funded, and the beneficiary is entitled to the distributions. When countable distributions are made, and that's a question really that you want to make sure you get advice from a professional such as an attorney like ourselves, who can tell you whether what distributions are countable, what aren't, and how you can go about reporting those. At any time, the relevant agencies, Medicaid, Social Security, they can request, they can demand a full accounting of what's been going on with the trust. Typically, this will happen if they've caught wind of something that potentially could cause a disruption in benefits. They're going to want to get the full picture to determine whether there in fact is an impact on the beneficiary's eligibility. And then when the beneficiary shows income from the trust on their tax return, again, these are means tested benefits. Many of them have an income eligibility component. So if there's any activity of the trust that's going to result in there being what Ethan referred to, as benefits income, not necessarily IRS, they're not necessarily the same. But if the beneficiary is going to have something where it's going to be counted as income, that needs to be reported. Social Security. So this is SSI. You have 10 days to report, 10 days following the end of the month where any of these events occur. So if the beneficiary changes their living arrangements, if they move, change addresses, and that's really primarily so that the Social Security Administration knows where to send notices and where to send, documents. Whether there's a change in the beneficiary's income, again, whether they are continuing to be eligible or not, change in resources, or if they are now newly eligible for some other benefits, if they've now made it to eligibility for a certain Medicaid waiver, or if they are now receiving food stamps or things like that. And you want to make sure that you report these as in a timely manner, because the longer that you go without reporting some of these things, Social Security is just going to keep sending that check until they have a reason to stop. But if something has happened that's made the beneficiary ineligible, and months and months go by and they're getting checks when they shouldn't have been, well, Social Security is going to want that money back, and that can cause a real headache, because it's either going to stop payments from coming, or they may even try to come after the trust or the beneficiary as a creditor. So any change, any of these things, report it. It's better to report and deal with whatever the consequences are to eligibility than to try to put bury your head in the sand and end up making the problem a whole lot worse. So the other thing that needs to be reported is changes to the beneficiary's status as a disabled individual. We'll get more into detail about how that's determined, but if the beneficiaries improves in their abilities, they may no longer meet that definition of disability. So you want to make sure that you keep that keep them up to date. So a change in the beneficiary's marital status. All of these means tested benefits have different eligibility criteria for married versus unmarried individuals. So if the beneficiary gets married, that needs to be reported so that, their eligibility can be evaluated in light of that. Admission or discharge from a health facility or public facility. By and large, the facilities themselves that are accepting these benefits, such as Medicaid, will have their own reporting requirements as well. So you may not have to affirmatively, yourselves as the trustee, make those reporting requirements, but keep a record as best you can as when your beneficiary has been admitted to or discharged from a facility. And then any intended trip outside the U.S. Again, this is for the protection of the war or of the beneficiary, so that if they're out of the country and payments are coming into their account, if they were out of the country and these payments are then being spent, in the country, that's red flag. The beneficiary may not have been receiving the benefit of those payments. So what happens then if something occurs? You get a notice from Social Security, from Medicaid, saying that the beneficiary's benefits are going to be stopped, or they're going to be reduced, or that they are no longer eligible. Appeal. Even if you think that this is correct, file an appeal, because these agencies make mistakes all the time. They misinterpret information. They don't know their own rules often. And so, it is frequent that these denials and these termination notices are not correct. If you get your appeal in right away, then whatever those benefits are will continue until the outcome of the appeal is resolved. If you still have a window of appeal, even if the benefits stop, you're allowed to still appeal that and get them restarted if you win your appeal. But in the meantime, you won't be receiving them. So you get your appeal in as quickly as you can, because you want to preserve those benefits and continue them for as long as possible. And I think I'm heading off to Helen now. I guess, unless I can real quick answer some of these questions here. Care management, as far as getting getting that care management in place ahead of time, anytime is fine. Give us a call, or get with a care management company, kick some tires, figure out, find out who you like, who sounds good, and then when the time comes, you can come back and give them a call and say, we're ready to move forward. We need those services. And then we can, an accountant who specializes, we can get some names for you if you need to. Just give us a call and talk to one of our attorneys. We can give you some guidance on that. Difference between SSI, SSDI. The difference is whether something is means tested, and we'll get into this more later, but SSI is a means tested benefit. SSDI is not a means tested benefit, and we'll get more into that later. If you win your appeal and you get your back payment from Social Security, there are particular rules about how that all works, whether it's income, when it's counted as a resource. So essentially, it's just as any other resource. You want to spend it on the benefit of the beneficiary, but you may not have to spend it all at once, because there's specific rules about those kinds of payments. You may have several months up to a year to spend those down before they are counted as a resource. Of course, you can always, well, not always, but you can frequently then put that access into the special needs trust so that it's continued to be protected. And then for Judy, Yeah, again, I think that, for particular scenarios for any of the individuals, let us know, and we can discuss your particular situation with you in more detail. And then look back, we're going to get to that here in a little bit. So stay tuned, because we'll be talking more about that look back later on. Okay, it's all yours, Helen.
Okay, thanks, George. Okay, so it's important to remember that your trust documents, and in fact, all of your estate planning documents need to be periodically reviewed. And why is that? Well, for very many reasons. You want to be really careful to make sure that any new trust assets are properly titled, and that all of your beneficiary forms are correctly assigned. As time goes on, circumstances might change, and you might, want to relook and make sure that you have the right people assigned to roles like trustee or trust advisor or guardian, and that can change. You might have younger children who can play those roles. Once they're, responsible adults, you might want to put them into a role that they weren't appropriate for when they were younger. The beneficiaries' situation might change. Their health might, improve so that they're no longer disabled. It might go downhill. Their eligibility for benefits might change. All of these things can make it necessary for you to make some changes to the documents. Your own finances might change. If they change significantly, you may need to make some tweaks. Life events occur, births, deaths, divorces, any of those things might warrant changes to your documents. Additionally, there could be things that have nothing to do with you. There could be significant changes to tax laws that would, hopefully not frequently, but might require some changes. And even if none of those things have happened to you, we just in general recommend, every 3 to 6 years, maybe every 5 years, it's good to kind of relook the documents and make sure that they're not stale and that there isn't something that you would want to change. Okay, next slide. So we've had a number of questions in the chat with people wanting to understand the difference in SSI and SSDI. So we're getting to the point where we're going to start talking about that. Before we get into those specifics, we need to go over, what is the definition of disability? And the definition of disability that matters for both SSI and SSDI is the definition that the Social Security Administration uses. And so it's important to understand that definition because it can be frustrating. You might have a family member who is, to you, clearly disabled, but if they don't meet the SSA definition, they might still not get benefits. So we have on the slide what the definition is. This is actually for an adult disabled person. SSA uses 2 different definitions. There's the definition for children under 18 and then for adults over 18. It's a little bit simpler for children. So for children to qualify, they have to be under 18. They have to have a physical or mental impairment that is expected to last for at least 12 months or result in death. And if they have that, the child will be found eligible or will be found to have a disability. It's a little more complicated for adults. So for an adult, you have to be 18 years or older. You have to have a physical or mental impairment that is expected to last at least 12 months or result in death. But here's what makes it a little bit trickier. It has to prevent them from engaging in substantial gainful activity. So you might think to yourself, what the heck is substantial gainful activity? You'll see the acronym SGA used for that. Basically, what that means is the person can't be able to earn more than $1,470 a month. And if they do earn more than $1,470 a month, they are participating and engaging in substantial gainful activity, and SSA will not consider them to be disabled. And that amount tends to go up every year. There's actually a different amount if your disability is blindness, you're able to actually earn about $1,000 a month more. But it's kind of critical to understand that, because you could have a person in a wheelchair, a person who's nonverbal, they're making $1,500 a month. SSA is going to say they're not disabled, and they may not be eligible for benefits. Okay, next slide. So now we're going to talk a little bit about SSDI and Medicare eligibility. And so, you know, the important thing up front to know is that SSDI and Medicare are not means tested. And so what does that mean? It means that they are not subject to the very restrictive income and resource limits that SSI and Medicaid have. So very different. SSDI is not a fixed amount of money. You know, we're going to hear about SSI, that it's $914 a month. There's no fixed amount for SSDI because it's based on a work history. So in order to be eligible for SSDI, you know, a person has to meet the SSA definition of being disabled, and then they have to have a work history, which means they worked long enough to have earned with these credits. And you can get like a maximum of 4 credits a year. And in general, you have to have 40 credits in order to be eligible for SSDI, which translates to about, you have to have worked for about 10 years. Now, there are some exceptions to that. Younger people who just aren't old enough to have worked for 10 years could be eligible for SSDI, but you're not going to be eligible for SSDI if you don't have a work history. So if you do, and you meet the definition of being disabled, you can start getting SSDI 5 months after that determination has been made. And then 24 months after you get your first check, you will automatically get Medicare. It doesn't matter how old you are, you'll be eligible for Medicare 24 months after you get SSDI. The amount of SSDI that you got is going to be sort of, it'll be based on the average of your lifetime earnings. And so if you were a high earner, you're going to have more SSDI than somebody who didn't earn much. So that's SSDI and Medicare eligibility. Let's go to the next slide, because this is really very exciting. This is a great benefit. So SSDI can also be extended to adult children of people who had a work history. So if you are an adult disabled child of a worker and your disability happened before age 22, you can receive SSDI based on the work history of your parent, if your parent is retired, disabled, or deceased. So this is really good news for a lot of our clients, because it's a way for their adult disabled children to get more benefits than what SSI might be paying, and to not be under the restrictions of income and resource that SSI puts onto people. But the important things here are the child has to have been disabled prior to age 22. So if they get in a car crash at 30 and they're in a wheelchair for the rest of their life, they're not going to be eligible for SSDI based on their parents' work history. And then the parent has to themselves be collecting regular Social Security retirement benefits or SSDI, or they have to be deceased. The child can only collect based on one parent. So if both parents are collecting Social Security, or both, or one of them is collecting SSDI and the other is collecting regular Social Security, you can't double dip. The child can receive SSDI based on whichever parent had the higher payment. And the amount that the child will get is 50% of whatever the living parent is receiving. So if the parent is alive and receiving regular Social Security, or the parent is alive and receiving SSDI, the child will get 50% of that amount. It doesn't ding what the parent gets, it's just additional money. If the parent is deceased, the child will get 75% of what the parent was receiving. So for many of our clients, this is, financially much better than SSI. So sometimes a child will collect SSI when they're 18, and they'll stay on SSI until their parent retires or their parent dies, and then they'll switch to SSDI. The important thing to note at the bottom of that slide, if we can just go back for 1 minute, we talked about SGA, the substantial gainful activity. If the child is able to work and they are earning more than SGA, they will eventually lose SSDI. So you have to kind of be mindful of that. It doesn't happen right away, but they will lose it eventually. Okay, next slide. SSI and Medicaid, those are the means tested benefits. And so those are the ones that have the restrictions. You can't have resources of more than $2,000, and you have to have low income. In Ohio and in many states now, if you qualify for SSI, you automatically get Medicaid, so you don't have to apply separately for Medicaid anymore, which is very nice. And for this year, the maximum SSI that somebody can get is $914 a month. Really important thing we can't stress enough. In general, SSI is supposed to cover food and shelter. And so that's why if other people pay for food and shelter, there can be a reduction to your SSI. So you have to be really mindful about making payments of food and shelter. Okay. I think that's it for that section.
So there's a question that if a child has Down syndrome, but is working and then became entitled to SSDI, and then they are no longer working based off their disability in their later 20s, are they able to collect one parent who is retired? They will be able to collect off of their work history. It really depends on, Down syndrome is a disability that on its face that Social Security will say you're disabled since birth. So it depends on how much that child is working and in their work credits to determine can they also receive benefits from their parents' work history as well. It can be a little more if the parent has made more, which most likely that would be the case. Can you charge child rent if they live with you while on SSI? Yes, and what we advise clients to do is do a room and board agreement where you charge the child rent based off of the food and shelter expenses of the household and dividing that by the number of people that live in the household, and that is what that child pays in rent to the parent. So that will allow them to receive the full SSI benefit, and they will receive the full SSI benefit while also paying the rent to the parents. Can unspent SSDI income be distributed to the trust? Yes, if at the end of the month, if that account is over $2,000 and that person's on Medicaid, then SSDI can be distributed to a special needs trust. Can I take the SSI beneficiary out to dinner and not have it count towards food support? Yes, there shouldn't be any worry about paying for someone's paying for someone's restaurant bill from time to time. What they're concerned about is, what Social Security is concerned about is this person receiving all of their food expenses from a third party source, and where is their SSI money going? So you have to connect the dots between that, and you're telling a story of what you're doing with the SSI beneficiary's money every month. Can you explain SSDI in connection with also receiving Medicaid? So in the scenario that Helen was talking about, if someone was on SSI and then started receiving SSDI based off of their parents' work history, that person is grandfathered in to continue receiving Medicaid. So someone theoretically can be on SSDI, Medicare as their primary insurance, and then Medicaid as their secondary insurance. If they're also on Medicaid, that's when you have to worry about the asset limit of that $2,000. So although there's no asset limit for SSDI or Medicare, there is the asset limit for Medicaid. Someone asked, if a second parent dies who has a higher Social Security income than the first parent that has died, will it increase? Yes, it will increase to the higher earner. They will always receive the highest amount, depending on where it's coming from. Can SSDI be backdated to the date of disability and injury? It can be backdated 12 months from the application date. It can't be backdated more than 12 months. An accountant recommendation, if you reach out to us, we can give you an accountant recommendation. All right, someone else asked a question. If an adult child is earned above SGA at any time during their work history as an adult, doesn't that negate any opportunity to take advantage of the benefit from their parents' Social Security retirement when the parent applies for their own benefit? Doesn't that negate any opportunity to take advantage of the benefit from their parents' Social Security retirement? No, it should. It has no bearing on the parent's retirement, and it depends on if this adult child was on SSI or SSDI. If they're earning income, then they wouldn't be on SSI; they would be on SSDI. You always have to be mindful of if a person's on SSDI and they're working, and you wanted them to continue receiving Social Security, to not be over that SGA limit every month. Someone asked, my caseworker at Social Security continues to call my daughter's special needs trust a medical trust. Is there a difference? Yeah, there's a huge difference. I don't know what this medical trust is. Not a special needs trust. A special needs trust can be paid for any expense, not just medical expenses. So these caseworkers, they don't know terminology, and this caseworker is just confusing it. A medical trust, there are certain types of trusts that are used only for healthcare and medical expenses. A special needs trust encompasses a lot more than just that. Okay, so income versus resources. So this is just a continuation of benefits. There is a difference between what a person receives a month compared to what they have in the bank. So a receipt of for someone that's on SSI, there are certain, it's very weird when someone's on SSI with the reporting requirements. So if someone receives a $5,000 check, they win the lottery and they get $5,000 and they're on SSI and that's deposited in their account, that is considered income for SSI purposes for that month. So the next month that they receive SSI, Social Security will say, well, because you received $5,000 in income last month, you don't receive Social Security SSI for the next month. If that person has that $5,000 in their account beyond that month, they won't receive SSI until that's spent down below that $2,000 limit. So there is an asset requirement and an income requirement for these means tested benefits like SSI. So it's when all else fails, just contact us, contact an attorney to see, what you need to do, because, receiving money for anyone else is, that's great, but receiving money and you're disabled and you're on these benefits, that's scary for these disabled individuals. SSI, when someone's on SSI, Social Security goes through this weird formula of what they count as earned income and unearned income. I'm going to hit some highlights here. They disregard the first $20 a month of unearned income. So that is $100 that mom gives the child for whatever, just as a gift. Well, that's unearned income for Social Security purposes, so they disregard the first $20. Then if they have earned income, they disregard the first $65 and plus 1/2 of what they've earned. So if they have a job and they only worked to get $500 a month, they disregard the $65 and then they disregard 1/2 of that's remaining. So let's see if I can do quick math in my head. That's roughly $270 of earned income, which they will then reduce from their SSI. These IRWEs, impaired related work expenses, this is if a disabled individual needs certain items or certain services that they need to pay for in order to work. Social Security won't count those expenses as income. So for example, if they have what's the term? Not a seeing eye dog, but a
Service
support animal, a support animal. So the expenses for the support animal is $100 a month. They will say, well, we will not deduct $100 from your income because you had to pay $100 to support your animal. Deeming, this is an important for minors who are disabled. The whole reason why for most individuals, a minor receiving money from SSI is few and far between, because a parent's income and assets deemed to the minor child. And then we have in-kind support and maintenance. That is the free food and shelter that a child receives by living with the parent. In-kind support and maintenance will decrease their SSI by 1/3. And then we talked about the Medicaid spend down. If someone's on Medicaid, they have to spend their money below $2,000 at the end of every month. Resources are owned by the individual and available to the individual, and that are not exempt. So there are certain items that are exempt, and I'll get into the next slide, or that are exempt. I'll get into the next slide. Deeming, of course, is from parent to child, and which, like I just said, it disallows them from receiving needs-based benefits if the parent has assets and resources. A quick overview of exempt resources. So a person can be on Medicaid and SSI and still receive those benefits, or still own these assets, excuse me. So household goods, a residence, their primary residence. You can own a house, you can own a car and still be on SSI and Medicaid. You can own a funeral contract, burial plots. You can have a whole life policy, insurance policy, if the face value, if the cash value is less than $2,000. If you receive a back payment from Social Security, that's exempt for 9 months. Medicaid, it's only exempt for 6 months. So you have time periods to spend that down. And of course, special needs trusts and third-party trusts, those are exempt as well. All right, George, I think you're up.
Okay. So just real quick, maybe I just want to catch up on some of the questions here.
Well, we're running a little out of time, so why don't we'll save the questions for the end then.
All right. So SSI, we've been talking about it, quite a bit here. This is the program for individuals with disabilities who don't have any income and don't have any ability to earn income and don't have a prior work history. The intent behind SSI is to provide basic food and shelter for these individuals so that they are not homeless. It's administered by the Social Security Administration. They're the ones who determine whether the person meets the criteria for disability, and it is means tested. The accountable resources have to be under $2,000, and their income has to be low. In other words, really below the benefit of $914 a month. So if somebody is eligible for SSI, they can receive up to $914 a month. They may receive less depending on their particular circumstances and whether they have their own other sources of income, whether somebody else is providing income in kind, and other reasons. Often somebody who is disabled is not capable of handling their own finances. And in that scenario, Social Security will appoint someone to be that person's representative payee, typically their parent, their guardian, their close family member. That person will receive the payment on behalf of the individual, and they then have an obligation to use those payments for the beneficiaries, for the recipient's benefit, and have reporting requirements to Social Security regarding that. So go on to the next slide. Medicaid is the means-tested health insurance benefit. So it provides health coverage for hospitalization, doctors, some outpatient care. And then there are programs within Medicaid to provide for some of these services and supports, such as home health aides. Medicaid will cover prescription drug coverage. They will cover durable medical equipment. The standard for Medicaid is whether the service is medically necessary. So if something is deemed medically necessary, Medicaid will cover it. If not, it will not. Medicaid Unlike Medicare, which is a federal administered program, and SSI, which is a federal administered program, Medicaid is administered at the state level. The federal government gives states a certain amount of money to provide Medicaid benefits, and the state is the one in charge of determining eligibility and what services are covered. In Ohio and in most other states, the eligibility criteria parallels that for SSI. So unmarried individuals can have no more than $2,000 in countable resources. Their income for Medicaid, in the context of somebody who is in fact disabled, they can have no more than $849 a month in countable income. Lots of different Medicaid programs and lots of different income thresholds for things as we can see down the road. Then talking about those Medicaid waivers, there are two agencies that administer the various Medicaid waivers in Ohio. And what we mean by a Medicaid waiver, and this confuses people a lot, the whole waiver part is that the state has requested from the federal government that they can use Medicaid funds that were for essentially nursing home care for other purposes. So those purposes may be for helping individuals in the community with disabilities, or individuals who are elderly living in the community to pay for their own health aides or an assisted living, something like that. So that's where that waiver comes from. It confuses people a lot. So there's two agencies that administer the various waivers in Ohio. So there's the Board of Developmental Disabilities that manages the individual options, level 1, and the self waivers. And then that says Medicaid, but it's the Department of Aging in conjunction with Medicaid that manages the home care waiver, the assisted living waiver, and the passport waiver. And without really getting into very detailed content, for the DD waivers, essentially the waivers encompass varying amounts of assistance that the person needs. So, for example, the level 1 waiver is going to provide some just basic assistance with things like job training, or maybe managing some of those care costs or care needs. Whereas something like individual options is gonna cover someone with more needs. So somebody who needs to live in a group home, or someone who has a lot of skilled nursing needs. The individual options is going to provide more coverage. For the Medicaid waivers for Medicaid waivers, the home care waiver and the passport waiver are very similar programs. Home care waiver is for individuals under the age of 60. Passport is for individuals over age 60. And in both of those programs, they will provide hands-on assistance with activities of daily living, such as bathing and dressing and grooming, help with house cleaning. They will provide home delivered meals on wheels. They will pay for some minor modifications to a home, such as putting in grab bars, things like that. So then there's also Medicaid buy-in for workers with disabilities. So if somebody is disabled and they are working, they can still get Medicaid health coverage, and they have a little bit more leeway in their eligibility requirements. They can earn a little more income, they can have a little bit more in countable resources, but they may also pay a premium for their Medicaid.
Okay, so we've talked a lot about food and shelter, and in particular food and shelter with respect to people who are receiving SSI benefits. And we've said in general, as the trustee, try not to pay for their food and shelter because SSI is supposed to pay for food and shelter. If you pay for it, it could ding their SSI benefits. And so that's what we want to just sort of remind you of here. In-kind support and maintenance is the term that the SSA uses to refer to the payment by a third party for food and shelter. And there's sort of a formula for how they figure out how much they're going to ding the person's SSI benefit. It'll be the lesser of either the actual amount paid or something called the presumed maximum value, the PMV. And Ethan earlier mentioned that an SSI payment might be reduced by 1/3. This comes from the PMV. So what they do is they take 1/3 of the SSI maximum, which is $914, they add $20 to it, and the presumed maximum value is currently $324. So if your loved one is getting SSI and they have a rent payment of $700 and you're paying it for them out of the trust, they won't ding the full $700, but they will ding them $324 and take that payment down to $590. The next slide is just a very simple example.
Yeah, I think we're going to just pass over these case examples just for our time is running out, but you guys
So
can
just
look
the
at.
takeaway there
Yeah.
is be really mindful. It's not to say it's never the right decision to help with food and shelter. That might be the right answer, but there will be some penalty to SSI recipients.
I'm going to go over, these next couple slides pretty quickly here. We just want to be mindful that at age 18, a lot of things happen for our disabled children. And because, at age 18, they are considered adults. They want to, they are considered legally competent at age 18, and maybe they aren't. So we need to talk about guardianship or power of attorney at that time. Can they sign for themselves? Can they understand the document? Then they qualify for SSI at age 18. Do we need to put in a room and board agreement to make sure that they are receiving the maximum amount in SSI? Age 18 it's a big stepping stone, which you just need to be mindful of if you have a child that's transitioning to adulthood. Once they are adults, and then you have to consider whether this child will be receiving SSDI benefits, and then Medicare eligibility, and how that is used with their Medicaid eligibility. So age 18, once a parent then retires or becomes disabled or passes away, that opens the door for SSDI. So these are big, life-changing events that we just need to be mindful of.
Okay, so types of trusts really I'll just cut to the chase with it here, is that there's the type of trust that is appropriate for the beneficiary depends on whose money we're talking about that's going to go into this trust. If it's the beneficiary's own money, that is going to be a special needs trust. Sometimes you hear called a D4A trust. And the key there is that the trust has to have that payback provision in it for Medicaid, and it has to have the Social Security reporting requirements, etc. If it's somebody else's money that's going to go into this trust, a parent doing their own estate planning, or somebody who wants to provide a gift for that benefit of that disabled individual, then it's put into a third party discretionary trust, wholly discretionary trust, and that does not require that Medicaid payback provision. Otherwise, they are largely the same. The trustee has the same types of powers, responsibilities, and purposes of the trust. the trust is assets are to be used for the benefit of the beneficiary, et cetera. And then you can go ahead and hit the next slide. The SSI has less restrictive rules for what counts as a exempt trust than Ohio Medicaid does. Ohio Medicaid requires a little bit more language in their trust in order to be considered not countable for Medicaid purposes. So these third-party trusts are really useful for parents and grandparents doing their own estate planning, particularly if they have a disabled child or a disabled grandchild, and they themselves are concerned about their eligibility for Medicaid for their own care in a nursing home or in assisted living, et cetera. If they were to give their loved one with disabilities money outright, irrespective of the consequences to the beneficiary, they themselves may find that they're restricted on Medicaid coverage because that could be counted as a transfer. So if a individual has a child or a grandchild under 65 who is disabled, they can set up a trust for them, and if it meets certain criteria, not only is that trust not counted as a resource for that disabled beneficiary, it's not counted as a penalized transfer for Medicaid as well. So if you have that situation, definitely give us a call, because it's something that we do quite a bit, and requires a careful consideration about both the giver and the recipient, but can preserve the benefits for both. And then finally, these self-titled trusts, these are these special needs trust again. These are, again, the disabled person owns or has the legal right to whatever these funds are. So this is, an inheritance that is already in probate, or has, the person has already passed and left money for the benefit of the individual. Proceeds from litigation. Oftentimes an accident or an injury has resulted in the person's disability, and they are going to be in line for compensation, either a settlement or a court award. Child support, if the parents of the disabled individual are separating or divorcing, and there's going to be child support. A castle case simply means that if the child is disabled, child support continues during that child's life, doesn't stop at 18. So, or one that we unfortunately see quite a bit, an attempt to create an exempt trust that does not meet all of these particular rules and criteria for exemption, and would be a countable resource, but for the fact, but we can take care of that by moving those assets into a trust that is exempt. So again, these self-settled, self-titled trusts require that Medicaid payback provision. So that's the key difference between the self-settled trust and the third-party trust. These Medicaid payback trusts, they can be established by the person themselves, or their parent, their grandparent, or their legal guardian, or by a court. If a guardian is going to be establishing this trust, then they're going to need court approval to do that, because again, guardians are under court supervision.
Okay, we're on the last section now. So all of the remaining slides, and we'll have access to the slides, pertain to ABLE accounts. And so rather than speaking to each slide, I'm just going to kind of give you the highlights of ABLE accounts, because it's something worth knowing about. Some of you may already have ABLE accounts. We just want to make sure everybody is aware of this tool. It's relatively new. It's less than 10 years old. ABLE stands for Achieving a Better Life Experience. And so Congress passed the ABLE Act in December of 2014, which said people with disabilities for the first time would be able to save and invest money without jeopardizing their eligibility for benefits like SSI and Medicaid. So this is really a huge deal because it takes away the restriction of only having $2,000 of resources. So currently, all states have the ability to open an ABLE account. In Ohio, it's called stable. So you might get confused. You'll hear about ABLE accounts and stable accounts. They are the same thing. Stable is Ohio's version of the ABLE account. Ohio was actually the first state in 2016 to offer an ABLE account in the form of stable. And really our stable account is considered to be probably among the best in the country. So you can open one ABLE account for a disabled person as long as that disabled person was disabled before they were 26 years old. And the account belongs to that person. They can open it themselves. You can open it for them. Their parent, their grandparent, their sibling, almost anybody can open it for them. And they can save in that account up to $100,000 with no impact to SSI or Medicaid. So that's huge. Now, if you go over $100,000, you will lose SSI until you dip below, but you won't lose Medicaid. And theoretically, you can go up to whatever the 529 cap is. And in Ohio, that's $517,000. So you could have a lot of money in a stable account. You probably wouldn't want to put that much money in it because, like a first party trust, it has a Medicaid component. So there's definitely a purpose for an ABLE account. For example, you can use it to pay for food and shelter without dinging your SSI. So that's great. But you don't want to have $500,000 in it, and then when the person dies, the state has a claim on it. So the way we tend to think about ABLE accounts or stable accounts, they can work very nicely with trusts. They don't replace the need for a trust necessarily, but they can work nicely together. The other thing that's restrictive about it is you're only allowed to put, this year it's $17,000 a year. It's whatever the federal gift tax exclusion is. So if you wanted to give somebody $75,000, you couldn't do it in 1 year. You can only put $17,000 a year in there. They're very easy to set up. You don't need an attorney to set up an ABLE account. You do it online. You can tie a debit card to it. You can move money from a trust to an ABLE account. You need to do that to pay for food and shelter. It's kind of a nice way to do it. Anyway, it's a complementary tool in your toolbox that can work very nicely with the trust. And I think that's about it.
So I noticed we're running out of time here, and I noticed that people put questions in the chat box, which we will respond to those questions directly. So if after the meeting has adjourned here. So as a recap here, I mean, this was a lot of information with these trustee schools, trust administration, benefits and trusts and ABLE accounts in general. But we are presenting a talk series in the next coming months about specific items like trusts and stable accounts and benefits that will be more tailored to those certain items. So this was just more of like an overview of things, and I know it's a lot of information. I wish we could probably talk all day about this, but that would be pretty boring for everyone, I think. So we stretched it out over the next few months, and hopefully we see many of you here. But if you have certain questions and specific questions, feel free to reach out to us. We will be happy to, email, talk on the phone, meet in person, about your individual needs and your family members' needs. But other than that, George, Helen, do you have any last words?
Just again, everything is going to be posted on our website here, all of the slides, the recorded talk. So if there's anything that you needed to refer to, I know that I saw there was a question about the requirements for the Medicaid buy-in for workers with disabilities. That'll be posted on the website, so you'll be able to refer to that whenever you need to.
All right. Well, thank you, everyone, and enjoy your Saturday, and we'll see you guys later.